As of this moment, with the market live and trading, Beyond Meat, ticker BNYD, is at $1.36 per share, down about 2.1% on the day. And the first thing you need to understand is that this stock is not a company right now. It's a battlefield. The common narrative you'll hear is about a broken growth story, a plant-based fad that's over. But the reality, what's happening in the trenches, is a brutal, high-speed collision between one of the most aggressive, retail-driven short squeezes we've seen this year and the company that is simultaneously signaling profound financial distress. Just a few weeks ago, in late October, the stock was trading at 50 cents. It then exploded over 600% to hit $7.69. Today, it's at $1.36. This isn't just volatility. It's the aftermath of an eruption, and the retail traders who bought the top are now in a state of absolute disbelief, while the bears who survived the squeeze are reloading. The expectation was that this was the next GameStop. The reality is that it might be a textbook pump and dump, fueled by a company's own desperate financial maneuvering. Let's establish what everyone believed, especially just 2 or 3 weeks ago. The expectation was that Beyond Meat was the perfect setup for a historic squeeze. You had a massive, glaring short interest with over 51 million shares held short as of mid-October. That is an enormous bet against a company. Then you had a catalyst. The company announced a debt restructuring. This news, combined with its inclusion in a popular meme stock ETF, was gasoline on the fire. The retail army on Reddit, on X, and on StockTwits mobilized. They saw a stock at 50 cents, remembered the all-time highs above $200, saw the short interest and piled in. The volume was astronomical, unlike anything we've seen, even compared to other meme stocks. We saw days with 1.5 billion, even 2 billion shares traded. The stock, as we noted, went vertical. The feeling was electric. The frustration that had built up for years among long-term holders was finally released. They felt they were finally beating the hedge funds, finally getting revenge on the short sellers who had been hammering this stock down for 2 straight years. The dominant narrative online was squeeze, diamond hands, and to the moon. Now let's talk about the cold, hard reality that set in. That 600% rally evaporated in days. The stock collapsed from $7.69 all the way back to where it is now. And the retail community is, to put it mildly, devastated. The forums are now littered with what they call bag holders, people who bought in at $4, $5, or even $7, convinced the squeeze was just starting. There is profound anger, confusion, and a desperate search for answers. Many are screaming manipulation, claiming the rally was halted, that it was an organized pump-and-dump scheme. There are even complex theories circulating on Reddit about how AI-driven trading bots may have fueled the run-up just to prey on retail market orders at the open, trapping them at the highs. The feeling of disbelief is palpable. One user on r/Wall Street Bets posted a screenshot of their position, down 80%, with the simple caption, "I was told this was the next one. Now I can't even afford groceries." This is the emotional carnage left behind when the expectation of a squeeze meets the reality of a broken company. And here is the reality they missed, the detail that got lost in the squeeze hysteria. That debt restructuring? It wasn't just a simple cleanup of the balance sheet. As part of the deal, Beyond Meat issued 326 million new shares of common stock. Let that number sink in. This wasn't a small dilution, it was a flood. The entire public float was only around 70 million shares before this. The company effectively quadrupled its share count, dumping an ocean of new supply onto the market precisely as retail traders were desperately buying. This is the central tension. The retail bulls were trying to squeeze a limited supply of shares, while the company itself, in a desperate move to stay alive, was creating a near unlimited supply. The short sellers who got squeezed out likely just turned around and re-shorted the stock at $5, $6, or even $7, knowing this massive dilution was coming. The company used the retail-driven squeeze as exit liquidity to recapitalize its failing business. It was a brutal, cynical, but perhaps necessary move for survival. This brings us to the present moment, in the fundamentals, which are frankly appalling. The The reason this stock is trading at $1.36 isn't just because the squeeze failed. It's because the business itself is failing. The biggest red flag right now is the company's upcoming third-quarter earnings report. It was originally scheduled for November 4th, just a few days ago. They abruptly delayed it. They pushed the report to November 11th. Why? According to their own press release, they need more time to assess material impairment charges. This is corporate language for, we are writing down the value of our assets because they are not worth what we said they were. This is a massive negative signal to the market. It suggests their factories, their equipment, or their international operations are in deep trouble. They are telling investors, just before they report, that the numbers are going to be so bad they need extra time to calculate the damage. The preliminary numbers they've already hinted at are terrible. They're guiding for Q3 revenue to be down around 14% year over year. This isn't a slowdown, it's a contraction. This follows a Q2 where revenue already fell by nearly 20%. People are buying less Beyond Meat, not more. The company is in a state of cash burn that is terrifying. In the first half of 2025 alone, they posted an adjusted EBITDA loss of over $64 million. They are burning cash at a rate that, combined with their revenue collapse, puts their very solvency in question. This is why they did the massive 326 million share dilution. They were running out of time. Their international expansion, which was once a key part of the bull thesis, is in full retreat. They are substantially ceasing operations in China, a market they once touted as their biggest growth opportunity. Every pillar of the original growth story is crumbling. This isn't happening in a vacuum. The entire plant-based meat category is facing a day of reckoning. The expectation, pushed by Wall Street during the IPO, was that this category would capture 10 or 20% of the traditional meat market. The reality is that the category has hit a wall. The primary barrier is price. In an inflationary environment, consumers are trading down, not up. When a pound of conventional ground beef is cheaper than a small package of Beyond Meat, the average family will choose the cheaper option. The novelty is worn off, and consumers are left looking at a product that is more expensive, that many still find unconvincing in taste and texture, and that is increasingly facing criticism for being hyper-processed. The expectation was that consumers wanted a healthier, more ethical product. The reality is that most consumers want a cheaper product that tastes good, and the plant-based industry is currently failing on both fronts against its traditional competition. For those who are new to this name, Beyond Meat's business was supposed to be a two-pronged attack. First, get into every grocery store, the retail channel. Second, get into every fast food chain, the food service channel. Both have stalled. The retail channel is saturated. Grocery stores are cutting back on the number of plant-based options, not expanding them. The food service channel has been a string of high-profile disappointments. The McPlant at McDonald's in the U.S. was a failure. The partnerships with Yum brands, Taco Bell, KFC, have been quiet and have not resulted in the permanent nationwide menu items bulls were counting on. The business model, which relied on rapid exponential growth to cover its high research and fixed costs, is now working in reverse. So as a trader or investor, you are caught in this violent cross-current. On one side, you have the squeeze narrative. The short interest is still high, and the retail army, though wounded, is still watching. They point to the expanded partnership with Walmart as a sign of hope, a piece of good news that the market is ignoring. They see the $1.36 price and think it's a cheap entry for the next squeeze. On the other side, you have the fundamental reality traders. They see the delayed earnings, the material impairment charge, the massive dilution, the collapsing revenue, and the category headwinds, and they see a company in its final act. They see the analyst consensus, which is a strong sell with price targets from major banks like TD Cowen at 80 cents. This is the core of the frustration you see online. The remaining bulls feel completely betrayed, not just by the short sellers, but by the company's management, who dumped 326 million shares into their buy-in frenzy. The bears feel completely vindicated, seeing the squeeze as a final irrational spasm before the stock's inevitable decline to under $1. The tension is between what the stock did, the squeeze to $7.69, and what the company is, a business that is shrinking and running out of options. Given this massive 326 million share dilution on one hand versus the still high short interest on the other, what do you think defines this stock's future? Comment below with dilution if you think the share dump is the real story, or squeeze if you think the retail can make it run again. Looking forward, the pathways are stark. The bull case, as such it is, no longer has anything to do with the company's profits or sales. The bull case is purely technical. It's a bet that the retail meme energy can coalesce one more time, triggered by some unknown catalyst, and force another short-covering rally. The problem is that it's much, much harder to squeeze a stock with a 400 million share float than one with 70 million share float. The bears have a lot more ammunition now. The bear case, which is also the analyst and institutional case, is far more straightforward. The company will report its disastrous Q3 earnings on November 11th. The impairment charge will likely be huge